Markets at a critical junction amid bond market drama. Hi everyone and welcome to Ainslie Insights, brought to you by ainslie.com.au, the home of Ainslie Bullion, Ainslie Crypto, Ainslie Wealth and the Gold and Silver Standard. Be sure to have a look. Today, welcome back Dhruv, who's been looking at the bond markets. It's something that has been capturing a lot of attention. We've had lots of certainly noise or conversation on the social media platforms around the 10-year in particular blowing up, around other countries potentially having an issue there. We had debt downgrades in the US. It's all happening. How are you going today, Dhruv?
Good, Chris. How are you?
Yeah, I'm good. I'm finding all of this quite a fascinating area to look at the moment because, like as I was highlighting there, we've had so many different, really quite significant events happening in the space, or at least ones that make for good headlines. Let's break it all down. I know you've been looking at this a little bit more closely. I think a lot of it started with that Moody's downgrade. What do you make of that?
Yeah, 100%. I think the word you used earlier, noise, is important. And like you said, the Moody's downgrade of US government securities down from AAA to AA1 is a news driven market move, right? So, like any other news driven market move, I don't think it requires too much attention. In fact, I think we need to really zoom out, look at the bigger picture, and see where we stand in the overall financial landscape. So we could look at a few things that we looked at a few weeks ago, like the S&P, the DXY, and then look at the 10-year amid that as well and just see where all the pieces fit together. And is this something really to panic about? Because we've got people literally sounding the alarm bells on social media, talking about, it's happening, this is the end of the world. So it's something that I wouldn't get too lost in. But let's just have a quick look at what's happening now. Just to touch upon the downgrade as well, there are three major rating agencies. Moody's is just one of them, and the other two, Standard and Poor is one, and Fitch is the other. They already downgraded U.S. government securities years ago. I believe one was in 2011, one was in 2023, roughly around those times. So Moody's is just the third one out of the three to finally capitulate. And
that was really interesting as well, because when whichever one was first, it might have been Fitch, I can't remember, but whoever was first, that created an actual problem because at that stage you could only hold, or a number of these rules were you could only hold the highest rated securities. So when that was lowered, that created a real issue because then all of a sudden, could they even hold this? But it's been a long time since then. So the third shoe to drop, so to speak, does it even matter?
well, that's the thing, right? So there's certainly a reaction to it, but like you said, does it even matter at this point? Um, the issues around US government debt are no secret. They're really common knowledge. There's about $37 trillion worth of debt, and the interest alone on those are about $1 trillion a year. There's $9 trillion worth of that debt. So about 25% of it that's being refinanced this year alone at a higher interest rate than it originally was. So I believe that debt was issued in 2020. So the interest rate's now so much higher. And refinancing at the current interest rates over 2025, let's say they hold interest rates, steady while refinancing, I believe it's going to add $200 to $300 billion in interest payments. So that's another 20 to 30% just on interest payments at the current rate. So this is all common knowledge. It's no secret that the US really needs to refinance at a lower interest rate, and they're going to need some significant bond market manipulation to get the interest rates down to a sensible level. And we can get into that in a minute, but just to really quickly take a step back and look at what happened. I think the downgrade was about 3 days ago, and the bond market drama was about, I think it was yesterday actually. So let's just have a quick look, first of all, at what's happened, not just with US government bonds, but we've got bond yields for most major governments around the world actually spiking simultaneously. So that's interesting that the US gets downgraded, and globally we're starting to see this panic. So you can see Germany, France, UK, Spain, Italy, Japan, and Australia actually spiking simultaneously as well. And just like most social media posts, it's hyped up with an alarm bell and a caption saying it's happening, everybody needs to panic. But zooming into the US 10-year specifically, let's just look at the chart and what this actually looks like, slightly zoomed out. Here we have the US 10-year yield on the long dated government debt. Now, this has been chopping around sideways for a couple of years now. We see this downward trend line. It broke out from this trend line. This was the Trump tariff panic. Now, we've covered this extensively, and we've actually been tracking the recovery from this tariff panic quite closely as well. So it's probably worth following up on that and just seeing where all these markets stand today from the Trump tariff panic recovery. But you had this huge spike. The MOVE index, which tracks bond market volatility, hit close to 140 at that level, which is incredibly high historically. As you can see, there's quite an exaggerated move. But look, zooming out, I mean, this is still a lower high. The reason I've drawn this trend line here and this horizontal line here is because what I wanted to see for a downtrend break and an uptrend is you've got breakout, you've got a retest of this trend line right down to it. You want to see resumption above this 4.5 level roughly, right? So you break up above this and you start closing candles on the daily or the weekly above this level, then you've got breakout, retest, resumption. But what you can see here is this is the panic that we're talking about right now. This Moody's downgrade, the move index didn't even really spike up too much. So the volatility wasn't much at all. You can see it on this chart. It's really just hit this exact level where you would expect the breakout, and it's gotten rejected off it with a bearish hammer, an inverted hammer. So you can see a wick up there. What I think this is just a little bit of a fake out on the resumption. And what we might see over here is a continued downtrend from here. Now, this will really split the room. We've got a lot of people expecting the 10-year to move up. Others will say to move down. Look, I wouldn't even be surprised if we actually just see continued chop for a little bit longer. And, we can still see quantitative easing. We can still see liquidity increasing. We can still see markets rally amid the 10-year chopping around sideways. In fact, leading into the GFC, I'm quite sure we actually had the 10-year chopping around sideways as well. That being said, I think the US government, and this is probably one thing that Trump and Powell agree on, is they really would want to get the yields down and the interest rates down for that $9 trillion of refinancing that's coming up.
I think that's a really important point to make, that yes, even on that technical level, it might be, you could effectively argue the worst might be over, because as you've highlighted, it might sort of break down from there in terms of the move index, which would say the volatility is reducing. It's back to effectively business as usual. But the longer term issue has not only not been solved, it's getting much, much worse, because if you have all of this debt that can't be refinanced at lower rates, it's kicking the can down the road. But in the past, they were kicking the can down the road for 30 years at a time, 20 years at a time, 10 years at a time. Now we're kicking the can down the road for 2 years, or even less, because we don't have the capacity at this point in time in the bond market to absorb really the longer dated duration, the longer dated lower rate thing that you want to do. You want to push, if you're in government, you want to kick that interest can down the road. You want it as low as possible for as long as possible, so that's not an issue. If it's high rates and it's coming back due again in 2 years, yes, it might be sideways, but ultimately is 5% the new 2% here, that we just can't get interest rates down to the levels that we've had in the past because the system's broken and they just keep Band-Aid after Band-Aid's not working anymore?
Yeah, look, it's complicated. Like you said, it might just be a new normal, right? Because the expectation is they would want to get the 10-year down. They would want to get interest rates down and refinance at a lower level. But they just keep raising the debt ceiling anyway. And if you've got $1 trillion in interest payments and it's 136% of the GDP is the debt, and that I think that's a projection in the next couple of years, and that's just going to continue increasing. And they're spending more on interest payments than the military. At what point do they say we need to, at what point do they actually fix this and turn the car around? And what does this eventually lead to? Is it a massive tantrum in the bond market? Is it a reset of the system? I don't know is the answer to that. And I think most people would just be speculating. But at this point, I think it's safe to say that it is in their best interest to bring down the 10-year. And inflation is going to come about regardless of whether they lower interest rates, whether they have a bit of QE. It does seem like after maybe a short period of disinflation, deflation, which is the current downtrend, inflation is moving down. That trend will stop and turn around, and we should have another round of inflation just because of the government debt. The only way for them to deal with this government debt and to service this government debt is to increase liquidity, is to actually reduce the real value of the debt by reducing the value of the currency in which it's denominated. So it's the way the government can fund their debt problem is via inflation. So as much as the Federal Reserve will keep talking about, it's really important for us to bring inflation down, and that's our core objective. I think that's just a lot of jawboning where they're trying to create a certain image, and at the end of the day, I think they know that inflation is part of the solution for them, even though it's a problem for the everyday person.
So what about some people will say the solution to this? Yes, the inflation, which is obviously bad for everyone because that's everyone paying for it. But they would say the solution is to cut government spending. Now, has Doge lived up to its promise here? Because a chart that I saw recently was showing that actually in the time since Trump has come in as president, the spending is higher under this Doge cutting spending regime than it was under Biden's last year. And you go, well, wasn't the whole point that they were going to cut spending? And then you hear about this big, beautiful bill that's really even increasing spending even more and really seems to be completely disregarding any concept of restraint. Is that the issue here? Why you say that we can only solve this, well, that there is no solution effectively, that it can only be more government, more liquidity coming into the system, more inflation as a solution, because the cutting spending one, just no one seems to want to tackle it, even when they say that's a top priority.
100%. Look, it's baked into the cake. It's part of the system. For as long as we have a debt-based system and elections every 4 years, you're not going to have someone do the difficult and unpopular work of cutting spending and increasing productivity and balancing the books. It's just not going to happen. And especially if you're the world reserve currency, it's you hold all the cards. So why would you do that? Unless you want to take a multi-decade view, which you wouldn't do if you're running for elections every 4 years. So whether you're a populist or whether you're someone who's more a socialist, whichever candidate is running against each other, which seem to be the two options, these days in a capitalist world, you've got one who's more a populist and one who's more a socialist. Government spending is part of the equation. That will keep increasing. Everything else is about image, about face, and whether it's the Federal Reserve or whether it's the politicians, it's all about image at this point. The problems are systemic, and until we have an overhaul of the entire system, a solution will really involve playing their game and understanding the rules of it so that you don't be a victim of it, but rather you benefit from it.
Final question to sort of wrap this up. If we bring this back home to the Australian context, we've obviously just been through an election. We've now got a government continuing that tends to probably align more on that spending side. You would argue it doesn't seem to matter based on the US example, whether you're on the right or left of politics, that everyone's spending, as you've highlighted. Do you think that we have any buffer at all here? I mean, you pulled up that chart before that showed Australia was actually in many ways worse because our 10-year was even higher in terms of yield. So, those rates are very high already. Is it worse here, better here? How do you see Australia fitting into this mix? Because often the perception, at least, is that we're in a somewhat worse situation when it comes to government debt because for one, we don't have the global reserve currency backing us.
100%. Whether you look at government debt or even individual household debt, Australia is in a worse situation than the US. I believe Australia is one of the most indebted nations in the world, right after the Swiss. So the situation here is certainly worse. And like you said, we're not the reserve currency. So our options are very limited in terms of how we actually tackle the problem. I don't see things getting better for Australians, and I don't see the Aussie dollar gaining heaps of strength either. So the currency that Aussies are holding is losing value even faster. It's a weaker currency. It's a weaker horse in the glue factory. And so we're holding a currency that's getting weaker faster than the US, and our debt ratios are way off, is way worse than the US as well. So for Australians listening, when I said before about learning the rules of the game and playing them so you benefit from the game rather than being a victim of it, the name of the game is really hard assets and keeping pace with asset inflation, and that will help you outperform consumer inflation. And so that just brings it back to simple solutions like holding gold, holding silver. Whether you're a believer in Bitcoin or not, I'll leave that up to the individual to decide, but that is essentially a perfect form of hard money that's fully digital as well. And even things like land, anything that's limited in supply. Now, land's a whole separate conversation about how much you actually own it and how sovereign that asset really is. But assets like gold and Bitcoin are good options for people that want to be empowered, that want to benefit from this corrupt system, or at least not be a victim of it.
Yeah, it's a lot to take in, the whole concept of the economics here, the macro, how it all fits together, and then that solution is a tough pill to swallow. But once people understand it, they seem to certainly feel a lot more confident that they have at least a little bit of control back in their own financial future, because it's certainly a lot of doom and gloom when you just look at the debt situation. It's not a pretty picture.
Yeah, absolutely. And it might be doom and gloom in terms of the problem, but the solution certainly isn't. Gold and silver have been used as monetary metals for thousands of years, and an ounce of silver you can get it for like $55 to $60. If someone who has their first job and wants to save, they can buy like an ounce or two of silver every week and put that aside. You'd have 50 to 100 ounces of silver by the end of the year. That very quickly will turn into $20, $30, $40,000, in the first 4 or 5 years of you working. And then you see a massive silver bull run. So there are ways to exist in this system that are positive, that are based in intrinsic value, based in discipline, consistency, and thousands of years of a god-given asset like gold and silver is something that will help you sidestep a corrupt human system. And these human systems change every 80 to 100 years anyway. So these same cycles happen over and over again, and everything that has been will be. So there's nothing new under the sun. You just need to take when I say broad zoomed out view, look at thousands of years as you move from a centennial cycle to the next, which is basically where we are right now. So it's really just not to get too caught up in human-made systems.
Always appreciate the positive spin on the end there. It really does offer a little bit of hope. So thank you so much, as always, for your deep dive on that today. It's an interesting area that's certainly getting a lot of headlines at the moment, and we're paying attention to what happens to those bond yields. But ultimately, the debt solution is not getting solved anytime soon. So thanks for your work on that, Dhruv, and we'll speak again soon.
Thanks, Chris. Good to talk to you.
Good to talk to you. Thanks, everyone, for watching. We'll chat again soon.